Good afternoon, this is Bob Iaccino coming from the CME Group trading floor in Chicago. Talking energy, got to still talk about crude oil as the rally continues. WTI up another 1%. We are now up over 15.5% since the start of the OPEC meeting last week Thursday, where they decided they would increase production from anywhere to 600,000 to 1 million barrels a day. And we're up the last 2 weeks solid. If you go from that particular point, we're up closer to 16%. Again, reaching above $74 in WTI, even Brent crude, which is where the OPEC production increase will live, is up over 5%. The spreads come in quite a bit, the spread between WTI and Brent, since this has all happened. Now, a lot of it has to do with what the U.S. said about Iran, at least the last day and a half or so of the rally. And Iran responded overnight, saying that it's really impossible to remove Iranian crude from the market by November 4th. And they may not be wrong in terms of overall supply. One of the things that the OPEC production increase does is it takes spare capacity out of the market. We've already lost capacity in Venezuela. We've been losing for 18 months. We've lost capacity in Libya with rebels turning over control of 2 major oil ports to a non-Tripoli based group of rebels, faction of rebels. So that production's off the market. And if that were to continue, you could lose up to 840,000 barrels a day in Libya. So if you get just a 600,000 barrel increase, even a 1 million barrel increase, currently OPEC has been operating at 152% of the promised production cut. So well over what they were going to cut. Making up 600,000 barrels is making up a little bit more than the 52% extra they've cut already. So not really a factor, and Iran is probably not wrong in terms of removing all those barrels of oil because the price would spike even more than it currently has. Then we've also got demand showing up. You can have demand estimates, but demand actually showing up is a big driver of price, and it's showing up in the refineries. We got the EIA data yesterday. It wasn't just the 9.9 million barrel draw that caused part of the rally. It was the 97.5% capacity that U.S. refineries are now operating at. That is massive, that is unsustainable, and it's showing the demand you have for refined product as well as raw crude oil. We don't have more refineries in the U.S. That's why we're exporting more and more of the oil, and refineries are still operating at over 97%, which again, in the physical oil patch is considered essentially full capacity. So refineries stretched to the limit. Transport from the Permian and Eagle Ford difficult to get to the export ports, and then again there's nowhere else really for that oil to go. So pulling it out of the ground doesn't even necessarily help to drive prices lower. This is Bob Iaccino talking about a really strong crude oil price in WTI from the CME Group trading floor in Chicago.